Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, the final one for 2022, I'd like to talk about the massive reduction in consumer spending I expect to occur next year and the consequences of that. So, as you'd be well aware, the RBA's hiked interest rates for 8 successive months by a total of 3%. So, variable rate home loans are now in the early to mid 5%. And interest-only investment loans are approaching 6% in terms of current interest rates once all those rate hikes, particularly December, is passed on. Obviously, fixed-rate borrowers have avoided higher interest rates this year. And, of course, a lot of people fixed during COVID 2020 and 2021. But a lot of those fixed-rate mortgages are expiring beginning next year and the year after. And as such, borrowers will experience pretty substantial hikes in repayments when that occurs. And it's my thesis that, those higher repayments are going to have a pretty big impact on consumer spending. Now, whilst higher interest rates are coming our way, we have to acknowledge that households are in a pretty robust financial situation. So, many Australians enjoyed vastly improved cash flow during COVID when interest rates were at all-time lows, both variable and fixed. Fixed rates were kind of sub 2% at a particular point in time. And people couldn't spend money on their usual leisure activities. So expenditure was down, income was up, and Australians did two things with that improved cash flow. The first thing what they did is increase their savings rate and or made extra repayments on loans. So really improve their liquidity buffers, their financial buffers to sort of prepare for higher interest rates. And in fact, according to RBA data, household savings deposits grew by over $500 billion, $500 billion, between the start of 2020 and mid-2022. So that's a 21% increase in savings. When you look at the increase in liabilities, it's much lower, about 12%. So really, households are actually in a stronger financial position and more prepared to take on or being able to take on these higher interest rates. Secondly, Australians spent money, particularly even during COVID, during the lockdowns. We saw online spending peak during those periods of time. But when lockdowns lifted, we saw regular, normal retail offline spending recover almost straight away. And really total spending, according to CBA data, so they compile a lot of data from their credit card spending, up until the end of November, total spending was still about 30% higher than pre-COVID. So it's still very elevated, although things like retail and eating out have been declining over recent months, as you'd kind of expect. Now, of course, when borrowers are faced with higher interest rates, sometimes they're faced with the decision of, should I pay my mortgage or should I go out for dinner? And of course, virtually everyone's going to say, well, I'll pay my liabilities first. So I expect discretionary expenditure to significantly reduce as, one, these interest rates are passed on to variable rate borrowers, and most importantly, as fixed rate borrowers come out of their fixed rate period. And what I've done is charted the household interest bill based on that data. And then I've imputed, what that data, because it's historical, it has a 2 or 3 month time lag. I've imputed what will that interest rate burden look like in 2023 once the December rate hike is passed on. And this assumes, of course, that every borrower is on a variable interest rate, which of course is not correct, but a large amount of borrowers are coming off fixed throughout next year and the year after. And it shows that the interest bill will be the highest in real terms it's ever been. It was touched at this level in mid-2008, just before the GFC hit and the RBA started to cut interest rates. but the interest rate bill is substantial. I don't expect mortgage default rates to increase. However, most borrowers have been tested that they can afford a loan at these current interest rates. So if you took out a loan when interest rates were very low during COVID, banks would add a buffer of 3%. And so we've seen that 3% hike pushed through by the RBA. So as long as there's not any more substantial hikes, maybe there's one or two, but as long as there's not any sort of substantial hikes, I really don't think we'll see a massive increase in default rates or forced sales or these sorts of things. It might not be easy or comfortable, but borrowers will really tend to explore all avenues in order to stay in their family home and not default and have to sell it. So, of course, I remind you that savings have swelled by 21% over the last couple of years. So, firstly, they'll cut discretionary expenditure. Secondly, they might have to dip into savings. But that's kind of the point of squirreling away those monies anyway, because people realise interest rates were so low. We should put some money aside when interest rates rise. So we might have to eat into those savings. And in the main, that'll be enough to get most borrowers through. Now, of course, there's going to be some borrowers that have either overborrowed or their circumstances have changed. And those borrowers are going to experience financial stress and might have to make the decision to sell their home or downsize or do something along those lines. But I think they're likely to be the minority. And I think that's less likely to occur in investment grade locations, most importantly, really from an investor's standpoint. Now, you might be sitting back and thinking, oh, great, there's this cash flow crunch coming, discretionary expenditure will fall, maybe we'll see some bargains in the property market. Well, as I did an episode a few weeks ago, I think we're, if we're not at the bottom, very close to it. So I don't expect property prices to fall. I mean, it's important to point out that current property prices reflect both actual and expected interest rates. So that is, if you're going to go and buy a property today, you're going to take into account that, well, the RBA's just pushed through 3% of hikes, and maybe next year there might be another one or two interest rate hikes. So when I'm contemplating buying a property, I'm including the fact that the likelihood, or let's call it a fact, that that's going to happen, and that's reflected in the price that I'm willing to pay for that property. So the only way that I see property prices changing substantially is if expectations change substantially, particularly interest rate expectations or the significant rise in unemployment, but I'll get to that in a second. Otherwise, I think property buyers have already, I guess, digested the interest rate hikes, realise now that what the RBA was saying a couple of years ago, that rates wouldn't change until 2024, is now obviously nonsense, and have factored that into their decision making. And I think, the behavioural economics part of forecasting property price movements is what's missing in most of the commentary. Now, let's think about the stock market, though, which is a completely different story. If consumer discretionary spending plummets, like I expect it will, then company earnings will be adversely impacted. Now, we're seeing a slight revision down of company earnings, but nothing really substantial. The falls in share prices have mostly been valuation multiples rather than earnings driven. But if that starts to happen, particularly, obviously, the consumer discretionary sector is most at risk. If you're thinking like JB Hi-Fi and Harvey Norman and, those sorts of discretionary retailers, I can see that, well, I would expect, in fact, that their earnings are going to be hit substantially. But there's other sectors in the stock market that could be impacted. Information technology, although it's not a big sector in the Australian market. Consumer services, materials, industrials, real estate, financials, all those can be impacted to a greater or lesser extent than, probably lesser extent than consumer discretionary, but they're going to have an impact. I spoke last week about, shared my thoughts about defensive investing, particularly in gold, but, I elaborated the conversation about, how do you invest if you expect that there's going to be a recession or some economic problems in the future. So certainly refer back to last week's episode. But in short, I talked about using, value and quality factor indexes to sort of protect portfolio risk. Now let's look for the silver lining, as I always like to do. A dramatic reduction in consumer spending next year will probably solve our inflationary problems. So that's kind of good news. And given consumer spending is the largest component of GDP, gross domestic product, so a measure of economic activity in a country, it's possible that Australia will also then slip into a recession, although it might be a pretty shallow recession. And if that happens, it's likely that the RBA is going to have to move the interest rate setting. Currently, the interest rate setting is contractionary because most people forecast that the neutral interest rate is 2.5%. So when interest rates are above that, it's contractionary. The RBA is going to have to move that back down to neutral or even expansionary. So I don't think it's unlikely that we would see, if this all plays out like I have suggested it probably will, or at least I expect it will, I wouldn't be surprised to see the RBA cut maybe 1% off interest rates starting towards the end of 2023 and throughout 2024 to sort of recover that consumer confidence and spending and so forth. I think the good news is I think interest rates are unlikely to hang around for a long period of time. But the point is borrowers certainly should prepare for higher interest rates and mortgage repayments throughout most of next year with some possible relief in 2024. Okay, that's it for this week. And in fact, this year, I'd just like to thank all my regular listeners and probably even irregular ones as well for hanging in there throughout 2022. I produce this podcast every week, and it does take quite a bit of time to put together, particularly to come up with some thought-provoking and unique topics. But I hope it's been interesting and enjoyable. Hopefully you can stick with me throughout this podcast for the next year. And of course, I wish you and your family a fantastic and enjoyable and restful Christmas break and holiday period. Bye for now.